So I got a question on my Discord. Is it time to go back into intermediate and long-term bonds? This is an interesting one because if you've got money in a savings account, CD, money market, or anything else really short-term, which is pretty much everyone, this is an important question to be asking right now. Actually, it's a question I've been wrestling with myself over the past few weeks. So I'm going to take you through how I'm thinking about the outlook for intermediate and long-term bonds over the next year, as well as the role that they can play in a portfolio to help you answer the question, is it time to go back into intermediate and long-term bonds? Let's start with a quick refresher on some bond basics to make sure we're all on the same page. I'll put in chapters, so if you know how interest rates impact bond prices, you can skip ahead to the next chapter. Now, bonds go up in value when interest rates go down and vice versa. So since interest rates have gone up so much over the past 2 years, bonds have gone down a lot. So much so that it's been one of the worst bond markets in history, dating back to the 1800s. To take it one step further, long-term bonds are more sensitive to interest rate moves than short-term bonds because bonds usually pay you a fixed rate for a set period of time. And the longer you lock in that rate, the longer you're stuck with it. For example, if rates go up, the value of your bond will go down because it won't pay as much as a new bond with a higher rate and the same level of risk. So let's say you have a bond that pays 3% and interest rates go up to 4%. If it's a 1-year bond, you're only stuck earning 1% less for 1 year. If it's a 10-year bond, you're going to be stuck earning 1% less for 10 years. Obviously, that's worse, which is why longer-term bonds are more sensitive to changes in interest rates than shorter-term bonds. The reason I've been wrestling with the question myself lately is because the market environment looks a lot more favorable for intermediate and long-term bonds than it has for the past few years. Get this, in 2019 and 2020, I roughly doubled my money in a leveraged long-term bond ETF, the ticker's TMF, which is now down over 90% since I sold out. But is it time to get back in? I thought it was too early back in February when I said,
between 6 months and a year from now, the market is expecting the Fed to cut interest rates by nearly 100 basis points. Then I think there's a good chance the Fed doesn't cut rates as quickly. That would send rates higher in the intermediate part of the yield curve, meaning more downside for bond prices. But for me in bonds, it means I want to focus on the shorter term part of the curve right now, like in 6-month or 1-year bonds.
Since that video came out, the Fed has raised interest rates, not lowered them, just as I predicted. Short-term bonds have been up, while intermediate and long-term bonds have gotten crushed. But now, things are very different for 3 reasons. First, you're getting paid a lot more in long-term bonds now. You can see from the red line when my last video came out that short-term bonds in the 6-month and 1-year range were paying roughly 1% more than intermediate and long-term bonds, about 5% versus more like 4%. Now, the blue line shows that the gap has narrowed to more like 0.5%. Still not a normal environment where longer term bonds pay more than shorter term bonds, but much closer than before. Second, inflation is falling closer to the Fed's 2% target this time, and I expect it to reach the mid-2s by the end of 2024. I've got a 2-part inflation series coming soon, so I won't go too deep here, but if you break down the individual components of inflation, a lot of them are already below the Fed's 2% target, or I'm projecting them to be there by the end of next year. 2% inflation is the magic number because the Fed keeps rates high to get inflation down to that goal. Once inflation is around 2%, they can think about lowering interest rates. But for intermediate and long-term bonds, what's more important than what the Fed does with interest rates is what people think they will do with interest rates in the future. I think that whether or not the Fed lowers short-term rates in 2024, intermediate and long-term rates can go down as long as inflation gets near 2%. It's the anticipation of them lowering short-term rates in the future that will cause intermediate and long-term interest rates to go down. And if interest rates go down, bond prices go up. The third reason it's really different now is because the economy is on fire, in a good way. And a lot of people are thinking there will not be a recession. Therefore, it's no longer priced into the market like it was at the beginning of the year. However, I'm highly skeptical of those views. I believe Biden's massive stimulus that drove inflation has also helped counteract the impacts of rising rates. I think that's temporarily masking the many signs of weakness in the economy. Credit is tightening, the job market is showing some initial cracks, excess stimulus money is running out, consumer spending is weakening, people are having a harder time paying their credit card bills and car loans. I could literally go on for 30 minutes about this, but I think you get the point. Now, if we do get a recession, which is what I expect, that will put even more downward pressure on inflation and thus interest rates. So why am I not rushing to longer term bonds? Well, we've been in a unique environment from 2008 to 2021. And I'm not sure we're going back to that. What I mean is the Fed started a massive quantitative easing plan, which meant they bought trillions of dollars of long-term bonds, which artificially drove their yields down. Before the global financial crisis in 2008, it was pretty common for 10-year real interest rates to be in the 2 to 3% range during normal times. The real interest rate is just the interest rate you see, which is called the nominal interest rate minus inflation. So if I'm right and inflation falls to 2.5% and you have a 2.5% real interest rate on 10-year treasury bonds, that would mean they'd have a 5% yield. That's pretty much exactly what they're yielding right now. So even if inflation keeps gradually falling to 2.5% and the Fed eventually cuts short-term rates, there's no guarantee that long-term interest rates will come down. And if long-term interest rates don't come down, you don't make money in long-term bonds, other than what you collect from the yield. So I think intermediate and long-term bonds are okay to go back into, but I do think there's still some downside risk if yields go higher, and I do not think there's a ton of upside without a recession. If we do get a recession, I think it's more likely that intermediate and long-term bonds will do well in that scenario. When you couple that with the fact that the stock market looks expensive to me and it would most likely go down in a recession, I think intermediate and long-term bonds are attractive again as a hedge to your risky stock positions. I don't think they're attractive yet as a standalone investment. Well, at least the picture isn't quite as clear as it was to me in 2019. If I'm wrong about inflation and it stays higher for longer than I expect, long-term bonds will probably not do well. If I'm right and we get a recession, long-term bonds could do very well. So there's a wide range of outcomes, especially if you wanted to use a leveraged ETF. Ooh, my favorite. If that's a gamble you want to take, more power to you. I might hop back in at some point, but I'm not quite there yet. However, if you wanted to buy, say, a core bond fund with some of the money you have on the sidelines, and most of your money is still in the stock market, that is something that makes a lot more sense now than it did back in February. There's less downside risk from here, you get paid more interest as you wait, and it should act as a good hedge to your equities if there's a recession and a stock market correction. This video came from a question in my Discord, so if you have a question for me, join my free Discord. The link is below in the description, and thanks for watching.